My name is Jake, welcome to the channel. In today's video, I'm going to share with all of you how my wife and I are planning to retire earlier, faster. If you've been following along with the channel, my wife and I were in our mid-30s. We live down here in Austin, Texas. And our original plan when we were first starting on this fire journey of reaching financial independence and retiring early, we started back at the end of 2018. And when we were first putting together our plan, it was very vague. We didn't really necessarily know how we were going to get to where we wanted to be. We just knew that we didn't want to work our 9-to-5 jobs forever. We wanted to be financially independent. We really enjoy working. It's not that we're lazy and we just don't want to do anything. It's just we're in very high stressful careers. It's very challenging for us to keep up at the pace that we're at here in our 30s, in our 50s and our 60s. I don't believe that we're going to be able to maintain that stress level and a healthy lifestyle at the pace that we're going today. And that's completely fine. And we've accepted that. As I mentioned, when we were first starting about learning about financial independence, about dividend investing, and what was our preferred path to reaching financial independence, we put together kind of a vague goal. And okay, in 10 years, it'd be ideal if we can, live off of our passive income. We had those vague goals in place. It was kind of more like dreams. And it wasn't until we really sat down and put together a plan that helped us get to where we wanted to be. And I am so excited. In this video, I'm going to share with you all the things that we've considered when it comes to, getting our finances in check, helping us put ourselves in the best position possible so that we could retire earlier, faster. Retiring early doesn't mean just sitting on the beach doing nothing. It doesn't mean reading books all day. It means being financially independent to pursue other passions. Do things where it's not just money driven, right? We get paid very well in our day jobs, but because it's such a stressful career, we don't want to do that long term. We want to do other things. We want to travel. We want to experience different cultures. And ultimately, our long-term goal is we want to build a house in the mountains. And we want to retire in the mountains. Right now, we live in the city where there's thousands and thousands of people around us, and it's very busy. And our dream is to build a house in the mountains and really be free and have the opportunity to choose what we do with our time. Because that's the key thing here. It comes down to our time. So in the video here, we're going to talk about three things. The first part of the video is going to be all around things that my wife and I have considered when it comes to increasing the speed at which we can retire earlier, or at least putting ourselves in the position so that we can retire earlier. The second part of the video, I want to break down my wife and our plan, what we are actually doing, living and breathing so that we can retire in 5 years instead of 8 years. And then the last part of the video, I want to share some updates that I've made to the portfolio. The updates that I've made to the portfolio reflect this goal of retiring in 5 years instead of 8 years. And I'm going to talk a little bit about that, as well as I'm going to dive into my Vanguard portfolio. I've talked a lot about having 3 different portfolios. I have my cash flow portfolio, I have my real estate dedicated portfolio here in M1, but I also have a portfolio with Vanguard. And this portfolio I don't talk a lot about. And in this video, I want to really share my plan and my goals around this high dividend portfolio that I put together in my Vanguard account. I could talk about this topic for hours, but I'm going to do my very best to keep it as high level, but also go into as much detail as I can so that it's relevant for all of you that are watching and following along. Because I know there's a lot of you out there that are following the channel that are in a very similar situation that my wife and I are in. Maybe you make more money. Maybe you make less money. Maybe you're in a higher, a place in the United States or across the globe that's more expensive, less expensive. Everyone is in a different situation, but the things that I'm going to share here, they're transferable to everyone, regardless of where you live, your expenses, your income needs, everything. The things that I'm going to talk about in this video can be applicable to everyone here, whether you're in the United States or abroad, anywhere. I am so passionate about this topic of financial independence and retiring early from my dividend growth portfolio. I am so deep in thought when it comes to the numbers and optimizing the portfolio. If I increase it by a certain percentage, what is that going to mean in terms of the long-term growth of the portfolio? Are we going to be able to retire 5 years earlier, et cetera, et cetera? How much we're going to have in 7 years, 8 years? I love playing around with the dividend calculator. It's gotten to a point where my wife is, she's looked at me and she's like, "Are you okay? You're so deep in thought. Did I say something? Did I offend you?" I'm like, "No, honestly, I'm just thinking about if I invest more into AbbVie, that, we can retire sooner versus investing into, Microsoft or Apple. And it gets me so excited thinking about this stuff. But yeah, my wife literally asked me a couple weeks ago if everything was okay. And yeah, I had to think of this meme. So in the video, we're going to talk about growth. We're going to talk about value. And typically when I think about my investing goals, I'm really more focused on dividend investing. But when I see all these hyper growth companies out there like Tesla, and I see how quickly they're growing, it kind of makes me feel like this.
I'm just there till my divorce is final.
Now, who is coconuts enough to divorce you?
Oh, we gotta go. But we'll see you around.
Well, we'll have to have you over sometime.
I'd love it.
All right.
Bye.
Bye. She's awesome.
No, we are never having her over. Heard she already slept with 2 dads from the school.
What?
Mm-hmm.
That's horrible.
I love that. All right, cool. So when my wife and I were first putting together our plan in terms of planning out how long it's going to take us to reach financial independence. Now, some of you are using maybe a different method, whether it be, the 4% rule if you're following the traditional FIRE movement, but I think it's important to understand the rule of 72. How long it's going to take an investment to double. So if you're investing into a dividend company, how quickly is that company growing versus if you're investing into a growth company, how fast is that company going to grow or that investment? So if you're investing into a company or an ETF or whatever, an investment that's growing at a 1% rate, it's going to take you roughly 70 years to double your money or to get to 100%, right? So if you're investing into the S&P 500 that's averaged right around 10%, these last couple of years it's been a little bit more, you're going to double your money about every 7 years. And so when you're thinking about your portfolio, depending on how long you have to go, it's important that you understand the rule of 72. The next important thing is really making sure that you understand your goal. If you've been following the channel, I always talk about this because that is what my wife and I struggled with the most. And because we are living this, right? We've been on this path for 2.5 years. And when we were first starting out, we didn't really have dedicated goals. We just kind of had our dream and we just, set out for it. We didn't really have a detailed goal. And it's okay if you don't have all of your goals, lined up in detail, but you really have to understand what is your goal. Are you investing for growth? Are you investing for value? Are you going to leverage the dividend in 5 years, 10 years, 20 years? The time horizon really dictates how you should be investing. And that is so important. And when we were putting together our plan, that was a fundamental part of making sure that we got this right, was understanding our goal. The next piece of this was really increasing our savings rate. If you follow the FIRE movement, you're going to hear, the savings rate time and time again because this is so important. This is the amount that you're investing into your portfolio. So you have, your income that is coming in, you have your expenses, and what's left over is your savings rate. And that's what you hopefully are investing into your portfolio. So really increasing your savings rate is so key to being able to retire sooner. The higher you can get your savings rate up, the faster you're able to retire. I've shared an entire video on how my wife and I were able to increase our savings rate up to 70%. So if you're interested in that, in the topic of savings rate, I would recommend going and checking out that video. So the next piece is, well, how do we increase our savings rate? And I harp on these 3 things because these are so paramount when it comes to increasing your savings rate. It's all about getting out of consumer debt. Don't, buy that brand new car. Don't have credit card debt, all of that stuff, cutting your consumer debt. The next thing is cutting your expenses. If you're paying too much for your phone bill, see if you can reduce your phone bill. See if you can reduce your utility bill, your internet bill, things, your discretionary items that you're spending money on, and see if you can kind of trim that down a bit. And then the third thing is look and see if you can make more money. Are there other areas that you can focus on, increasing your income? Can you side hustle? The last thing here is it really comes down to understanding inflation and the impact of inflation, that silent killer that's in the background that you don't really see on a day-to-day day-to-day basis, as well as optimizing for tax efficiency. Those are really the things that you have to understand when you're putting together your plan to retire earlier, because those things will come and bite you in the butt if you don't really have them in check. Now I want to share what my wife and I are doing so that we can retire earlier faster. Now, our approach, it's not a one-step process. It's actually a multi-pronged approach. We're looking at things from different angles. We're planning for different scenarios that may happen in our lives, with the economy, with the global market. Like, there's so many things that are taking place that we take a multi-pronged approach to our early retirement. We do it a little bit different than the traditional FIRE movement, where we're investing for dividend growth. We're investing to live off of our dividend portfolio, and not the traditional FIRE movement where we're looking to liquidate, 4% of our portfolio. We want to live off of our portfolio from the dividend income. So the first thing that we do when we're setting up our portfolio, we look at this from a core and satellite approach. So if you're unfamiliar with this, really the theme here is you're going to have your core positions, your core holdings, your core investments make up the bulk of your overall portfolio. And then you have these satellite positions where, you kind of like, you're reaching for the moon. You're not 100% sure, but you don't want to risk everything. You're focusing. Your core is really what you're going to depend on. And the satellite, that could be like your Tesla, that could be your Bitcoin, that could be your gold, that could be your hedge against the unknown, right? That could be real estate. There's so many different things that satellite could be. And that's why when people ask me, Jake, would you ever consider investing into X, Y, and Z? Because I invest with the core and satellite methodology, the approach, I'm always open to new things. Yeah, of course I would consider investing into Bitcoin. Do I do it today? No. But would I consider it? Yeah, absolutely. And it would make up a small percentage of my overall portfolio, and that would make up the satellite part of my portfolio. But I still have my core. The core is there to stabilize the portfolio and something that I could really depend on. It's not speculative. So let me give you an example. A core position in my portfolio would be my ETFs, my dividend ETFs. That would be VYM from Vanguard, SCHD from Schwab, for example. It would also be my strongest conviction stocks, my individual companies like Pepsi, Coca-Cola. It would be Johnson & Johnson, 3M, Procter & Gamble, Kimberly-Clark. Those type of companies, those make up my core positions in my portfolio. Now, the majority of the time, like our core holdings, they're not the sexiest. They're just there. They're consistent. They're stable. Most of the noise happens around the satellite. That's your Bitcoin. That's your Tesla. That's your ARK ETF. All of those things, that's where the majority of the noise happens. But my core positions, that's what I'm banking on and relying on so that I can retire early. The next piece is understanding where you're holding your investments. There's different investment account types, especially here in the United States. It may be different if you're outside of the US, but here in the United States, we have taxable accounts and we have tax deferred accounts or tax advantage accounts. All of the accounts that I share here on YouTube, they're all taxable accounts. My dividend portfolio is in a taxable account. Despite being in a taxable account, the first years in early retirement, I will pay 0 capital gains tax. And if you're interested on how I'm going to do that, I'll leave a link in the top right and how my wife and I are going to pay 0 capital gains tax on our dividend income in the first years of early retirement. It's actually really, really cool. We also have tax sheltered accounts where we're focused mostly on growth and the broad US stock market. We invest into the Vanguard, VGT, the technology ETF, as well as the total stock market. And we also have some small exposure to international and real estate. So once again, focusing on the core and the satellite. So now that we understand the core and the satellite approach, we understand that there's different investment account types. We also understand, thanks to the rule of 72, that every investment is growing at a different rate. My wife and I, we invest for growth. We also invest for dividend growth. We invest into companies, more traditional, dividend companies like Johnson & Johnson and Pepsi. But my wife, through my wife's portfolio, we also invest into Amazon, Google, Disney, Microsoft. This portfolio that my wife has is a little bit smaller. It's not as big as my dividend portfolio. By investing into both dividend and growth companies and investments, it gives us options in the future. For those of you that have been following the channel, you know that we also invest into real estate. I am a big fan of investing into real estate for your average person. Your average person, especially here in the United States, I can't speak for international, but here in the United States, investing into real estate is one of the best ways, in my opinion, to grow your net worth faster. At least that's been the experience for me. Now, I know that not every market is like the Austin market, which has increased by about 16% over the last year. Who knows if this is going to continue? You may be in another area in the country that's growing faster or slower, or even maybe potentially decreasing. The key thing here is understanding your circumstances. If my wife and I were maybe in the Midwest, or maybe in an area where the housing prices were not appreciating as much, we would not be investing in real estate as aggressively. My wife and I, we currently own about $1.5 million in real estate. This is not including the mortgages, of course. But we're investing more aggressively in real estate because of the opportunity that we have here in our market. If we did not live in Austin, or if we did not live in a market where the housing prices were appreciating as quickly, we would adjust our strategy and invest more into growth ETFs, like the ARK Innovation ETF, like the Vanguard Technology ETF. Because we're in such a growth market, we're taking advantage of this. So depending on your circumstance, depending on your market, you could do either or. You could invest into real estate, hoping, for the market to appreciate, or you could invest into growth stocks and ETFs, hoping for a similar outcome. The reason why I'm sharing this is it is so important that we have the growth from the real estate in order for us to retire in 5 years. Otherwise, it very likely would have been 8 years. And so if you're watching this video and you're thinking to yourself, okay, how can I increase the speed at which I'm able to retire earlier? Growth has to definitely be a piece of the puzzle that you're trying to solve for. If you're only investing into dividend companies, yes, that's a very effective way to building out your portfolio and growing passive income. But if you look at the big picture and if you think, okay, you pull back the layers, all right, we're building up our passive income portfolio, but we also have to invest for growth, whether that be in real estate, whether that be starting your own business, whether that be investing into growth ETFs. Whatever it may be, it's important that you don't lose sight of the growth while you're on this path to financial independence. My wife and I, once we reach financial independence in 5 years, we're then going to quit our day jobs. We're then going to sell the real estate that we have here in Austin. We don't want to be landlords in early retirement. That's not our passion long term. Once we've sold the properties, we're then going to do two things. We're going to reposition the money from our real estate into our dividend growth portfolios. After we've invested part of the proceeds from the properties into our portfolios, we're going to invest the remaining amount into building a home in the mountains. This is what it's all about. This is why we're hustling and sacrificing today so that we can live our dreams sooner in life, before the average age of 65. We're looking to live like nobody else today so that later we can live like nobody else. Now, for the remainder of the video, I want to go through and break down a few of the updates that I've made to my portfolio to adapt to our new strategy of retiring in 5 years versus 8 years or 10 years. It was kind of up in the air. Now we really have a plan of focusing on a 5-year plan. And so I want to go through and walk everybody through some of the updates that we've made to our portfolio. Towards the end of the video, I want to go and I want to break down my high dividend portfolio that I have in my Vanguard portfolio. As always, you can check out all of the links in the description below. You can check out my cash flow portfolio, my real estate portfolio. You can see that here. There's sub accounts with M1 Finance. It's absolutely great. I love it. You can have different accounts here. And my Vanguard portfolio, I link it down below. The pie there is just the investments and the allocation that I have in my Vanguard portfolio. That's all that is. So let's take a look and see some of the main changes or updates that I've made to the portfolio. So we talked a little bit about the core and the satellite. We talked about our core holdings. We talked about our satellite holdings. In my portfolio, I've had my core holdings. We talked about Johnson & Johnson, 3M, talked about Coca-Cola, Pepsi. The main update that I've made is I've reduced the amount of holdings that I have in this portfolio from 50 holdings down to 40 holdings. By doing that, I'm focusing focusing more on my core holdings. My core holdings are going to make up a larger percentage of my overall portfolio. So the companies that I sold out of, it doesn't mean that I don't have conviction in these companies. It's not me saying, hey, you watching this video, you should go sell these companies. By no means. Some of the companies that I sold in this portfolio, my wife holds in her portfolio. So that's very, very important. I don't want to send the wrong message. It's really me focusing and doubling down on my core holdings. So the first few things that I did here is I updated the slice allocation. I still have my dividend growth ETFs at the highest at 50%. I bumped up consumer staples from 13 to 15. I lowered industrials from 12 down to 8. And the majority of the sales that I made were in the industrials, actually. The utilities I bumped up from 8 to 10%. The healthcare I bumped up 1%. Consumer discretionary I brought it down from 3 to 2. Telecom I kept the same. Technology I kept the same. Materials I kept the same. And I got out of the financial ETF. Now let's take just a second and let's take a look at the companies that I sold and a few that I actually added. So for example, the ones that I sold out of Disney. Disney, I still have 100% conviction in Disney. Disney is in my wife's portfolio, which is more focused on growth. I just kind of repositioned it out of this portfolio, but we still have it in her portfolio. The Vanguard Financials ETF, I sold out of this ETF simply because the ETFs that I own in VYM have so much exposure to financials anyways. I felt like I didn't personally need this extra ETF in my portfolio. It's not that I think it's a bad ETF, it's just I get so much exposure through VYM. That's the reason why I made that decision. Now, I sold out of a few industrials. These industrials, these are great companies. These are such great companies. But the way that I looked at it is these were really my satellite positions in my portfolio. And so what I decided was I was going to trim the amount of satellite positions that I had in the portfolio and focus on increasing the core positions at a higher allocation. I am still a massive believer in Dover, A.O. Smith, and Republic Services, great companies. Now looking at the technologies, for example, with Apple and Visa, Apple is held in my wife's portfolio, Visa is held in my wife's portfolio. So similar to Disney, these are really great growth companies. I reposition them out of my portfolio. We still hold them in my wife's portfolio. When it comes to Raytheon, it's very similar to Dover and A.O. Smith. It's a great industrial company. I have exposure to Lockheed Martin and General Dynamics that I felt that I didn't need it in the portfolio as well. I also took out Consolidated Edison. I took out Consolidated Edison, but I increased my percentages to Southern Company and Duke, and I actually bought another utility which I'll share here in just a second. I also sold out of the Essentials Utilities. This really purely just has to do with the fact that I'm doubling down on the higher dividend given my current time frame. Microsoft is the same with Visa, Apple, and Disney. It's held in my wife's portfolio. And lastly here with Emerson Electric, this is an amazing dividend company, such a great company. This was one of the harder ones for me to take out because I really, really believe in the company. Similar to what I was doing with Dover and A.O. Smith is I wanted to focus more on my core holdings. That's the only reason why I sold out of Emerson Electric. Now let's take a look at a few that I've added to the portfolio. I've added the VPU, the Vanguard Utility ETF, to my portfolio as well. As I mentioned, with Consolidated Edison and with Essential Utilities, I think those are great utilities. For me, I wanted to focus a little bit more on getting broad exposure to the utility sector, and that's why I added VPU. In addition to adding the Vanguard Utility ETF to the portfolio, I've also added another consumer staple in Philip Morris. By repositioning the portfolio into 40 holdings, I'm increasing the value that I have in each individual stock. Each company that I have in the portfolio will now represent a larger stake when it comes to the actual dollars that I have invested into them. The core holdings in my portfolio will hold a larger position, have a larger weighting in my overall portfolio. The satellite stocks will have a smaller position relative to my core holdings. My core holdings generally have a higher starting yield. By focusing more on my core holdings and less on my satellite holdings, I'm increasing the starting yield of my portfolio. All right, now let's take a look at my Vanguard high dividend portfolio. You can find the link to this portfolio in the description below. This is not through M1 Finance. This pie here is simply a representation of what it looks like in my Vanguard account. As you can see, it's up about 30%, so nothing too crazy. This is a high yielding portfolio. It's looking for current income. It's not really focused on growth. The dividend yield is just over 4%. A couple of weeks ago, this dividend yield was just shy of 5%. So the investments in this portfolio have gone up dramatically these last couple of weeks. It has a low expense ratio and it has only 12 holdings. The portfolio is set up where 30% are in ETFs, in SCHD, VYM, and VNQ. And once again, this is in a taxable account. I have the other holdings pretty much equally weighted in Altria Group, AT&T, Coca-Cola, Kimberly-Clark, PepsiCo, Philip Morris, Procter & Gamble, Verizon, and Southern Company. Now, the important piece with this is all of these companies, with the exception of a few, pay a dividend on a different schedule. So I'm getting dividend income on a different schedule than your traditional March, June, September, and December. This is very important to me. As I'm looking to retire earlier, I want that consistent cash flow. I don't want to have cash flow only every 3 months. By doing it this way, it's spreading out the cash flow into every single month of the year. My wife and I have been investing for financial independence for 2.5 years now. I am so excited. I am as excited today as I was 2.5 years ago. If you're new to this, I hope that this was helpful. Thank you so much for watching, and I'll catch you in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.